We're good. Yeah, we're going. Yeah. We can do it. All right, guys, we're gonna go ahead and get started. All right, guys. Thank you guys for coming. We do this every single month. Seems like the turnout is a little low today, but thank you for coming either way. Hopefully, we can add some value to you. One thing we like to always start with is we do these. We're going to try to give some value. Adam's going to teach us about commercial debt and commercial financing, but you should come here and you need to build relationships with the individuals that are in the room, right? Because these are the individuals that are actively doing deals and participating in building businesses outside of this room. So what we like to always do is show of hands. Who here is doing wholesaling? Wholesaling deals? No? Short-term rentals. 2 short-term rentals. Who's flipping houses? 1 flip house. Long-term rentals? Good. Long-term rentals. Commercial financing, obviously, is Adam. We have a few residential financing here as well. So the thing is, guys, is make sure that you look at those faces, get their information, and go outside and start building a relationship, because the people in here are going to be how you build your business faster. Don't try to do it alone. You need to be with experts that are actively doing it on a consistent basis. That being said, I want to say and introduce Adam. Adam is a commercial financier, right? Which means he can help you find debt and equity in the commercial markets, right? So if you're raising capital for a project in the commercial space, it can be office, multifamily, retail, flex space, storage units. He can help place debt and equity in those markets. He has relationships throughout the country with all the lenders that are actively lending on those projects. And I'll say from firsthand that it's not about just calling the bank, your one commercial bank that is in your market. You have to have a very wide footprint when you're looking for financing for these particular bigger projects, because certain banks have access to certain capital at certain times, and you need to know who those are. Luckily, brokers are the ones that are doing the legwork and building those relationships while we're out looking for the deals, right? So you have lenders, you have brokers, and then you also have the deal finders, and he is your broker to help find the financing for your deal. So everybody give Adam a round of applause. Thank you, guys. Yeah, and we'll get started. So Adam, why don't you do a little introduction of things I missed, and we'll start with the questions.
Yeah, so I broker commercial debt, and some equity, but the equity is primarily more not quite sponsor level equity, but like preferred equity. So joint venture equity, but generally it's debt, and I've been doing it for about a little over 18 years. I have been doing it on my own since COVID for the past 3 or 4 years. I was at Marcus & Millichap, a large firm, for about 5 years, and I was actually on my own prior to that for 10 or so years. I've done a wide array of types of financing. Obviously done a ton of multifamily, but everything from SBA for owner-user business real estate to office to retail, industrial. I've kind of self-storage. In various times in my career, I've touched all parts of it. I'm a client borrower focused. I represent borrowers. I don't represent lenders. So if you're looking to me for help, I'm an extension of you, kind of like your finance arm. And my goal is to always look out for borrowers' interests. And I think that's it in a nutshell.
Yeah, great. So how we're going to structure this is I have a few questions that are going to be generic that we're going to ask Adam. And then I want you to bring questions as well. If you don't understand what a concept is, if you're typically in the residential space, that is okay. We are here to learn. Commercial is a different world, right? It's different than getting finance for a single family house, a condo, all the way up to a quadplex. This is a different world. So that's what Adam resource. Yeah. So what we're going to start
to that point, if I start saying stuff that's like industry lingo, so to speak, stop me, just raise your hand, just say, wait, what does that mean? What do those 3 letters mean or whatever? And I'm going to try not to do it, but you know how you guys probably do the same thing when you're talking to people. You fall into your industry lingo and just stop me.
Yep. So, and we're going to start with that. So everybody heard him say SBA, right? Or owner user. So we're going to start with that. What is an SBA loan or an owner user loan, and who is qualifying or typically applying and looking for those types of loans?
So SBA owner user is basically you have a business and that's what's going to occupy the property versus investor, which is where you're finding tenants. And for owner user, the government has a government-backed program called SBA, which is through the Small Business Administration. And the benefits of it is that they will offer you loans at as low as 10% down. And so they're just more favorable terms that way. It's a little more expensive as far as their fees and things, so they can ensure that, but they bake it in. So it's really you're not coming out of pocket for that. And it's a phenomenal way if you need space for your business to get in without putting a ton of capital in. And then, you can allow that, it is still a real estate investment, right? You're just leasing it from yourself. But it's if you're buying something for your business, it's the way to go. Because in most businesses, their capital is, you get a much higher return on your capital investing in your business than you do investing in the real estate you occupy.
And then, so to start off, if you're in the residential space, the thing that you hear is low money down, right? Primary residence financing, house hacking. You're trying to get into assets for cheaper, right? If you already live somewhere, but you run a business, I guess first, who owns a business or operates a business? Do you own rental properties? You technically, once you have a well functioning P&L, you own a business. If you own a property management firm, you own a business. If you own a construction company, you own a business. These owner occupied are ways that you can get into commercial assets for less than that 20, 25, 35, 30. I mean,
for those kinds of properties you're going to use, you're usually putting in more than you are in an apartment building. So it can easily be 30%, 35% in some cases. So the SBA loans they're tremendous for that. And it is, and you don't have to necessarily, ultimately you may decide you're not occupying it anymore with your business and you're going to be okay. Like you've got the debt, so you have that. Maybe you grow into another space, you move over and buy a bigger space for your business. You got this building you're going to lease out. You're still into it for 10%.
Is there a limit to the SBA loan? So essentially, if you outgrow your space and you turn that space into a rental, right, into a rentable space, can you still get another SBA loan on another commercial space?
Yeah, it's like $5.5 million total, but that's actually not loan amount. It's SBA guarantee portion. So if you were to there's 2 SBA loans, without getting into too much detail, but there's two SBA loans. One is for real estate only. And then the others, they're flagships called 7A, where you can do real estate or business. You have, so for the real estate one, you're getting half of the loan from a regular lender, right? So if you can, in theory, have like up to $12 million in debt, because the way you're still only using 5.5 of the SBA money. And then the other one is the 7A. They guarantee 75%. So that's, call it 9 million or something. And you're still, maybe not quite 9 million, maybe it's 8 million or so, but you can you're getting more than that 5.5 is the point.
And when they're underwriting you for these deals, they underwriting you specifically, your business, a hybrid of the business you and the real estate?
So typically, anything that you're going to guarantee, which you will with SBA, they are underwriting the business or the real estate if it's an investment, and they're underwriting you personally. They're looking at you as a sponsor, so they want to make sure that you have the financial wherewithal, so you have enough liquidity. Net worth, they'll look at, it's not necessarily a big driver. They will look at your income overall to make sure that you can cover your personal debts. They look at your credit, and so they'll look at all those things, and they do underwrite you personally. In a business loan, the biggest thing is the business. However, SBA will do startup businesses based on projections. You do need to have a little bit of other strength or outside income, typically, or a ton of experience in the industry, something that's going to make them comfortable that business is going to generate the income, or there's a backup source to pay it. But you can do. I mean, I've done a bunch of startups at SBA over the years. Brand new businesses.
And then one of the main reasons that to do this, and then we'll get off the SBA. So one stipulation, and you can correct me, but you have to occupy 51% of the space. So you can't buy a space you would only occupy 10 and have renters or tenants. They don't call them rent. I guess it's more of a tenant based.
Right.
And so 51% of the space. And then also when you're doing when you're buying these buildings, if you have owner occupied or you have other tenants in the space, the lenders are going to want how long of a lease term?
So it's a little bit more flexible, I think, with SBA with that. But generally speaking, they do care. Like, so in the residential world, it's a year by year thing, and everybody really cares what's on your lease. But if you they do look at what they call rollover risk in commercial. So they want to know they're giving you a loan fixed for 5 years. They're going to look and say, well, you got tenants, but their lease expires in 18 months. What happens then? And where's the rent? What's market rent look like compared to their rent? They're going to look at that stuff. In a perfect world, you have 5 years left on a lease. That doesn't necessarily. It's not a hard set thing. The other thing is if you have multiple tenants, so you'd see if because it is a great way to kind of combine the two. You get something. You get 10,000 square feet. You take 5,100, lease out 4,900. You may be covering a lion's share of your debt. But if you have, let's say, 3 tenants, they're going to look if every tenant expires in 3 years. That's a risk that they'll look at. They want to mitigate that risk because they say, okay, well, in 2027, in March of 2027, every one of your tenants could just leave. What's that going to look like? And they could possibly ask for some reserves to cover tenant improvement or leasing costs. However, we'll say that in a conventional loan, that is very typically the case. SBA is a little more flexible on that kind of stuff because they're really geared towards the business, and that's their mandate. It's a government mandate to help small businesses. It's I think it's an opportunity to be able to have tenants and have something that's going to cover your business because it's just the same. It's like when people buy a 4-unit, live in one of them to get an FHA loan, and now they're have 3 tenants paying their mortgage. It's a very similar structure.
Yeah. And so Adam was actually somebody that kind of the one that put a little fire under my butt to buy. We're actually going to be buying a commercial space as well that is going to be owner occupied, and we figured out a way. And I was like having trouble with conventional, and that's what we're going to go to next. So who likes or wants to get into multifamily? Right? Isn't that mostly everybody's end goal, right? It's single family house, duplex, quadplex, and then you want to go into the multifamily space, and eventually you want to sell all of that and then lend it to people that buy multifamily, right? Isn't that's the wealth? So let's talk about conventional multifamily debt in today's current market. What are you seeing? Is it hard? What are they underwriting at? So any insights?
So it is a bit of a strange time. You have this we had this event where rates went up extremely fast. It's been such a hot asset class for a very long time. You had a lot of people get into multi, and then even more get into it in like COVID period, just post-COVID, rock bottom rates, a lot of construction getting done, a lot of variable rates. It's put a lot of lenders into a tough spot now, though, because a lot of these borrowers can't get out of those loans. But lenders are still lending, and multi is still kind of the darling. It's it has a ton of distress, but it's still, when you talk about getting debt on new debt, I think it's still the easiest thing to get financing for. Lenders are still lending, although they're definitely much tighter, and there are much fewer lenders. So you have, I guess I should take a step back with one of the things you have, kind of, we're talking about SBA. What you also have with multi is Fannie Mae, Freddie Mac, and HUD. So they're government-backed lending. So they're like kind of always in business. And then you have conventional, which is more of like the banks and the credit unions. You also have non-bank lenders that are maybe private lenders, the hard money lenders you guys probably see, as well as we call them bridge lenders that are just, looking for short-term deals, but they're not hard money rates. Although they're much higher now because short-term rates are so high, and that's what they base it on. Like, prime, like anybody that had prime-based loans are in pain. You actually have much lower rates on a 5-year or 10-year than you do on a prime-based loan. But you have those main sources, but then you do also have like life companies and what's called CMBS, which is the commercial mortgage-backed securities. So you have a lot of different options, and they all love multi. The banks right now, which is around here, is a primary source, especially for renovation projects and construction. In other parts of the country, some of these bridge lenders and things and non-bank lenders are more common in construction and renovation. But around here, the banks are so aggressive. You have a lot of banks doing that, and they, to give you guys an example, we were getting 85% of cost on these construction projects. So value around here, the biggest way around here to get cash flow is to do value add, because you just for years you haven't been able to buy something that really cash flows, like, because cap rates would be like, if you don't know the way that you value apartment buildings commercial is by taking really a rate of return and applying that to the net income. So if you have so they call it a cap rate. It's basically if you didn't put any debt on a property and you bought it and you took the net income and divided it by the purchase price or the value, that's the cap rate. The returns have been so low that it was very difficult for years, and it still pretty much is, to buy something that's fully occupied and actually get cash flow. Like you would get like a very small amount. The way that people are getting it, though, is they're buying stuff, they're renovating it, they're adding bedrooms or they're adding units, or just taking it from a Class C to a Class B type of property, and now the rents go up. And so a lot of those deals, you're able to actually say, hey, I'm going to buy a property for $1 million. I'm going to put $500,000 into it, right? And then I'm going to have to carry it, and I'm going to have closing costs, right? So I'm into it for, let's say let's say $2 million, just for easy math. You actually can borrow against that $2 million instead of just that $1 million purchase price. So which means you can get in for less. Right? So let's say, we were doing it where you could get in for 15% of the cost, and there were multiple lenders doing that. I had sometimes with like 12%, 13%, just because at low rates, when you add the value, the cash flow was like through the roof.
Accelerates.
Yeah, it was just through the roof. Well, now what's happened between lenders pulling back, because a lot of these lenders have a lot of bad debt on their books, or potential bad debt, or their deposits are lower. They don't have a lot of capital, so they some aren't lending, or they're saying, you know what, that 85% of costs we'll do 75% of costs, we'll do 70. So then that in turn means more. You have to put more money in to get in the deal. And there's just far less, like I have like one lender left that I could probably get at 85%. And it's usually tough because what also happened with the rates went up. Well, the rates went up, your loan is driven by the difference essentially between your cash flow and your mortgage payment. The mortgage payment goes up, the cash flow is not going up, which means you need to lower the loan amount. And so that's kind of where we are. So even lenders that will say, I'll do 80% of the cost. I have one right now in Southeast DC where it's barely 75% of the cost. And it's with a lender that would do 85, but it could barely get to 75 because just it's, I think we're at like 7.5% interest rate. And it's just, the metrics just aren't there.
They're evaluating on the DSCR, right?
That's correct.
Yeah, so that's the debt service coverage ratio. So essentially, as the cost of money increases and your rents do not increase, now your return is going to be less, right? So typically, what are they underwriting at on the DSCR?
So
right?
Typically, roughly 1.25. So for every dollar of debt, you need to have $1.25 of net income, not rental income, but income after the expenses. So what really happens is not only does your return go down, but the bigger thing is your loan amount goes down. And that's what the big thing, that the biggest challenge is, because all of a sudden a deal that you might have needed, to get into a deal, maybe you needed $500,000, now you need $750,000. And not only does that hurt your cash on cash return, it's also, you need more investors, or you have to come out of pocket more, right? And if you need more investors, you probably also, in addition, have to give up more of the deal because those investors still want a pretty good return. Well, the only way that they can get a better return if you have to put more money in is you give up more of your piece. And so it has forced a lot more creativity. It has forced a lot of people to really try to figure out, how to get into deals, be more selective in the deals that they do. But the biggest thing I think with it is that to realize is lenders have pulled back a lot, across the board of lender type. So even lenders that don't have problems are scaling back with the concern that, what's going to happen if all these defaults come in, if all these properties that got a loan in 2022 at where they had a variable rate loan that was at 4%, it's out now 9%. And now they were expecting to refinance at 4.5 or 4 or 3.5, and now they have to refinance at 7. They either have to put money in, they have to sell the property, or it gets foreclosed. And you probably have seen a ton of stuff on the on the newsletters and stuff that you see come out in your email where they're talking about properties trading hands at a fraction of what they were sold for 5 years ago, 6 years ago. So those are the real, drivers of the banking world today. And, the biggest thing that I think people really need to focus on is really just, we were in a world where you could just make these assumptions of everything getting better. And it did, right? So even if you were wrong on stuff, the market picked you up. Rates got better, rents went higher, like rents were growing so fast. Now you really have to really underwrite things the right way, be conservative. You can't assume that everything's going to get better. It's kind of more of like, hey, let's assume things stay the same. Will this work? Because when rates first went up, I had people sending me pro formas, and their exit, when they were getting out of the deal, they were assuming rates are going to be back to 5% or 5.5. I'm like, how do you know?
Why can you assume?
Yeah, how can you make that assumption? That was like the common thing. And I'm like, you're assuming that things are going to be better. If they don't, what happens, right? And people, I see people, I've done deal with someone in August of 2022 that I'm trying to help them right now, where they got short-term equity because they were like definitely getting out of their deal in 12 to 18 months. And now they're paying like 18% preferred return to their equity, which means there's nothing left because they were planning to refinance, get all their equity back, buy their equity out, own the thing outright, or not outright, but own it themselves. And there's a ton of people in that situation. So I think now is the time to be.
So how are you helping that individual? So they get themselves into a bad situation, aside from foreclosure and selling, what are their options right now?
What we are doing is I've gone back to the existing lender and said, hey, they've added value, they've finished the project, it's successful, like everything worked out from a construction, and it took a little longer, and it cost a little more, which is another thing that's happened a lot. You know, there were several $100,000 over their budget, but
which had to come from either reserves or out of pocket or additional equity.
They were investing, so they were in a variable rate. They had a 12-month interest only period with a 12-month interest reserve, so they didn't have to pay interest for 12 months in theory, but the rate was probably whatever prime one, it was probably 3.5 or 4% when they got into it. So their 12-month interest reserve lasted probably 8 months, and then they were coming out of pocket with every month. I think their payment was $30,000. So they were coming out of pocket for that. They were coming out of pocket with construction overruns, and then so what we have though is a Capitol Hill property that has been renovated, added bedrooms, occupied, good rental, good net income. So we went back to the lender. I don't know if they've ever done a second, but we're like, hey, listen, they're going to leave, or we could give them a second. It's no difference. You guys have the first. What's the difference? You're going to second. Your first is their first was like it ended and it got fixed at 5.3% when it converted. So it was actually a good rate, which is the real reason we didn't want to leave it. But for the lender's purpose, it was, hey, they're going to leave you because they're going to refinance. There's no prepayment during this period, and the lender said, oh, well, we'll look at it that way. So the lender's going to do a second for them. That's going to get most of the capital they need. It's not going to get it all because it just still does not cash flow enough. But they're getting at least, so they have like a $4.5 million first. They're getting like $600,000 on the second. They wanted like 800. But the big benefit of getting a second also is that if they got a new first at $5 million, they're paying fees on $5 million. So they were going to, and the fees are overall costs are pretty high. So they would have, they're out of that $600,000, they're probably going to give up $30,000, right? Because that's just basically, if they had gone to $5 million, they were probably giving up $200,000. So that was the thing that we were able to figure out for them. The lender hadn't done that before, but it made sense for them. They get to keep the whole loan. They get to keep the relationship. They get, and the borrower's getting more. So it's win-win. But it was a hairy situation. Some things actually worked out. Like when their rate converted to a fixed rate, the treasuries were down. So they actually, because at one point it was going to be over 6%. But when it actually converted, it was a time when they were low, so they got it was 5.3, which
and the conversion was built in on the original.
It said at this point it's going to convert.
It will convert. Into
so it ended up they had a 6-month extension, so it was 18 months after they acquired it. It converted, and so they had some things that kind of worked out for them, and we got a little bit more, and they're going to be okay. Luckily, a lot of people aren't, but you're starting to see foreclosures out there or bankruptcies. Seems to be the bigger thing, and to hold off the foreclosures. But they're going to be all right, and that's just we just really it was just kind of banging our heads against the wall trying to figure out. We talked to every kind of lender prior to that. We talked to Fannie Mae, Freddie Mac, insurance companies, other banks. Like just nobody was given the proceeds. And we were able to get maximum proceeds this way.
I mean, so the moral of the story is in that space, right? So obviously there's Freddie, Fannie, there's HUD, there's agency, there's also conventional. The key is when you're buying these deals, right, you want to look at value add, which the ways to add value add just means how do we add value? In multifamily, you either increase the rents you decrease the expenses, and that's how you can increase and manipulate your NOI, which is the operating income that he keeps talking about. NOI is what these banks and what appraisers and what the market deems that is the income that it produces, and then they derive a cap rate off of that net operating income. That's how the value is picked, right? So that's how the value is not picked, derived of a multifamily building.
Yeah.
But key, or any type of commercial. But the key is, don't be a pro forma superhero, right? Don't try to promise these returns and promise these increases in rents, promise the increase or the decrease in cap rates, which people were doing as well.
Yes.
They're like, oh, we're buying it at a 5. We're going to add value, but don't worry, people are buying Class A at 4.5.
Yeah.
So we're going to add that much value.
And it makes a 0.5% in cap rate makes a huge difference in value. It doesn't seem like it would, but it makes a big difference. So these things, those little tweaks can really trip you up.
Yeah. And you can be in your pro forma, and it's an energy shot, right? You say, oh, if I can do it at a 5, from a 5.25 cap to a 5 cap, and I can get these rents, you're gonna oh, well, I'm gonna make $1.5 million.
Yeah.
You know,
spreadsheets,
right?
Yeah, you got to be careful with spreadsheets.
Correct.
Because you can make them look however you want. You know, and it's tempting. The thing that I would also tell you is that you want to have, in a way, 2 sets of books. Like, you know, it's kind of like a base case, best case, and worst case. And you want to be looking at that worst case as an investor, but I'm going to use the best case because I want to sell to the lenders.
As the broker.
Yeah, as the broker going to the lender, I'm going with the best case because one, lender's going to beat it up, right? They're going to they're never going to be like, oh, this guy or girl investor is really conservative, so we're just going to go with their numbers, or we're going to raise the numbers. No, they're going to be like, where can we beat this up? So go at it. I go at it with the best case scenario. It's got to be credible, right? We have to be able to support it. And that's something that I focus a lot on is where can we support, you know, the numbers to make it look better, to get more debt, because usually people want as much debt as they can get, and it's not the final stop. If it's the final stop, I recommend being more cautious because you are going to have to pay that debt. So if you get real creative and then you're stuck with that loan and you have to make payments on it, well, you need to have that income. So if you're real creative, you may not have that income. Lenders are going to continuously check your DSCR, your debt service coverage, right? Every year they do a test to say, are we still at the minimum? You know, and so you want to make sure you're there. But when we're doing the value add, where we're getting into the deal and we're either raising rents or we're lowering expenses or we're adding units to the mix, whatever it is that's going to increase the value, well, the plan is to exit it at some point. And you know, when you exit, then you're going to get your permanent loan. But before that, I look at it as my job, you know, unless told otherwise, because almost everybody I can come to me wants more money than I can get. You know, they're like, hey, I want, 85% in a deal that really carries 78%. So you got to try to figure out how to get there. And, you know, so that's why big recommendation is when you're doing stuff for your returns, what you expect, what you're going to have to deal with, be conservative, right? Because the other thing, not just the cost of the deal is always more, and the cost of the expenses on a property are almost always more than people pro forma. I mean, it's like a long time and know those a specific area and a specific, they'll usually start. You know, I know exactly what I'm going to have, but almost everybody else has got these, you know, they have such, you know, I don't know, and it's going to be renovated, so I'm not going to have any repair and maintenance, and, you know, and it's like bare bones, and it's rarely, you know, it rarely hits. So, you know, that I definitely recommend being conservative in what you believe, being aggressive in what we present.
And the key is too, like, if you are not just using your own money, right? You have to be the most important thing in this whole industry is the relationship with the individuals that are giving you the money, right? Your investors. So if you are over enthusiastic about a project and you are promising them X, right? You are going to lose investors and it's going to be much harder to get into your next project. So the key is be conservative, not only with yourself, but with the people that are giving you and providing the equity, right? In most cases, he's finding the debt. The people that you have that are giving you equity, you need to say, hey, here is your worst case scenario, right?
That's the base. For them, that's the only thing you're giving them essentially.
Yes. Worst case.
It's like worst case. Like even more conservative than you are with yourself, because they're going to expect whatever you tell them or more. So you definitely want to make sure that you're very aware that that is like more important than what you expect for yourself. That like that example I gave you guys, they overpromised the equity, and it's painful right now for them. And their biggest concern is exactly what Cassie's saying, is that they're trying to do other deals with these same investors, and they're like, we have to, like, they harassed me for this $600,000. Like, I'm actually doing another deal with them, like a $4.5 million acquisition, or actually no, they aren't acquired it through foreclosure, but it's like they need renovation money and all that, and so it's the main loan for that. They are harassing me daily about this $600,000 because they're concerned they've got other stuff under contract, and that it's friends and family, like, and so they're like, we need to get them their money, and they're actually, one of the guys is actually paying them the preferred return out of pocket, right? Because which
if you should, if you can, you should, to keep that relationship whole.
Right. But it's like it's not what the operating agreement does not call for coming out. It's if the preferred equity is not there, if the preferred return's not there, they don't get it. That's the whole thing about equity.
Legally, you don't get it.
But if you want them to, you want your investors to be happy, because that's they don't want to invest if they're not making the returns. So that's what people do. The goal, but the real thing that you do is you don't put yourself in a situation where you've overpromised and
underdelivered.
Well,
any questions so far?
Does the SBA work for multi-use properties, and do you have to occupy the business at more than 51% still?
SBA does not work for apartments at all. No, not even. There's nothing there. It's only commercial and has to be 51%.
And that can be mixed use though. There can be storefront retail with apartments above, correct? The SBA.
I believe, I haven't done that, but I believe you can, because as long as it's 51%.
As long as it's storefront.
As long as you have 51%.
You can't occupy the residential
And
space.
And that's strictly 51% interior square footage, or is that the entirety of the property?
So there can be some creativity.
Okay.
If it's used outside storage,
Trucks.
I know
parking lots,
a car dealer that uses he bought a space and he uses the outside space for his cars to store them, because he's in a place that there's not a lot of commercial condo, and then he has a detailer that leases from him. And when I first looked, he was asking me to help with it. I looked at him like, how'd you get an SBA loan on this? It's just leased to this guy. He's like, oh, I actually use. There's like it's in, I think it's in Fairfax, but it has a bunch of land around. It's like an old building, and he did. So there is, you can, and I've been told before, you just have to justify it. But it's a little more challenging, but if you can justify it, if there's actual use, you can get by that way. I don't know the exact calculation how it would work.
So we'll do one more. We're going to do one more topic, and then we'll open it up to more Q&A. So one of the biggest things that you hear now, if you can't buy it, you build it, right? Construction loans, right? So getting construction loans, what are you seeing in the marketplace right now for those particular projects?
So construction's a little hairier than existing renovation. There are some lenders that are glad to still do multi-renovation, but they're like, we're not doing ground up construction. It's still, you can still get it. It's tougher. And I actually will know a little bit better over the next week or two, because I just started working on a 25 unit in Northwest DC that someone's going to be building I forgot what's there. It's like I think like some kind of single story retail, and they're going to be building like 25 units there. So I'll be going to market with that. I'll have a better feel, but just from conversation, there's a lot. Conversation with lenders, there's a lot less lenders that really want to do the ground up, and there's a lot less people trying to do ground up because I think that overall the construction costs are so much higher. It's really hard to get stuff to pencil, and land values or property that you're going to tear down, whatever you're buying, the values, a lot of that stuff hasn't come down enough that makes up for the construction costs, and then that's combined obviously with the interest rates. So you combine the additional construction costs with the higher interest rates, it makes it tough to get them to pencil without a ton of equity. That's actually one of the big things that I'm like, he's looking for 75 for cost, and I'm questioning. One of the things I'm doing right now is we're going back and forth on, hey, how'd you come up with these rents? Because I think his rents might be a little high, and even 10%, 15% too high makes an enormous difference in how much loan you can get. But yeah, construction overall, you can do it. It's going to be more conservative in loan to cost. I would not expect an 80 or 85% of cost unless you were bringing other types of financing in, like mezzanine, which is kind of like a second, or preferred equity, which is it's equity, but it's below your equity, right? They get paid before you do. You need to do something like that. So the deal really has to be fruitful to carry that, and make sense.
And the key is, guys, with construction, there's no income, right? At least when you're doing value add, you have some of those units that you're not vacating, right? Or if you don't vacate the entire building, that is producing income that can help carry the carrying cost and a percentage of the debt. With the construction, in most cases, in my experience, some of it's IO or interest only, but you are having to make consistent payments on a monthly basis out of pocket, hopefully out of reserves.
Yeah, they'll usually force you to have a fully funded interest reserve. Yeah. The other thing is it takes longer to do ground up. There's no income coming in. It's riskier for the lender because it's easier for the lender to be like, all right, that building exists. You're going to make it better. We're budgeting to do that. But when it's ground up, like there's just so many other things that can happen. As far as what if it doesn't ever get built? What if there's the permitting process is a lot more extensive. There's just so many other factors. I mean, people that were doing construction during COVID got blown up, a lot of them, because all of a sudden the cost for 2x4s went up tenfold. The cost of like the transformers and stuff like that I had a lady that was doing a major renovation in Northwest DC. It was like $5.5 million renovation. She was waiting months to get. She had to get a heavy up, and it was, I want to say it could have been 6, 8, 9, 12 months. It was there was a lot of problems with that project, so it took a long time anyway. But it ended up getting started dead at the beginning of COVID, and every problem that you heard about in COVID, she experienced. Some of it fell on the contractor because it was a guaranteed price. So some of the lumber issues fell on the contractor. But there was every material you can imagine went up in cost. And then, getting HVAC units, right? You couldn't, they were going to Pennsylvania and all these other places trying to get stuff because they couldn't get the materials. And, a lot of those projects suffered for people. I mean, some of them, were able to pull through it, but that was a big problem.
So if you're doing ground up, large interest reserve, again, being conservative with the cost of construction
and time
and the time that it's going to take to complete. And most of the time these lenders are going to want to have especially how fully permitted, I'm assuming, before they'll.
Before they let you start drawing, you don't always have to be fully permanent, but most of the time, I say almost every time, you're going to need to get like a performance bond. And really the level of contractor you need to do ground up is definitely more significant than the level you need to do a renovation project. which also means that your cost of construction per square foot is going to be typically higher. Just because a lot of times when you're doing a multifamily value add or any kind of construction, if it's an existing building and it's not a ton of construction, you might be using a smaller guy. You may be using someone that doesn't even have doesn't have their name on their truck type of thing. And you see a lot of people have they've got their contractor, right, and they do their thing. But when it comes to the ground up, you usually need to have someone that is reputable and has has backing, because they're going to want a performance bond, because they want to make sure that if that person fails, that they have insurance that's going to now come in and make sure that job gets completed.
Great. Let's kind of open it up for Q&A. So we talked about multifamily, we talked about SBA owner user, how to buy something cheaper in the commercial space, and then also the cost of building. Who has questions, particular scenarios that you'd like Adam to take a look at, or give his insights on? Anything?
Is there a minimum amount of time you need to fill that space for if you are going to move into it for a lower percentage down? Is there a minimum amount of time you need to occupy?
So usually
that
within a
space?
year. So meaning, because sometimes people will buy something that's leased, for instance.
Yeah.
If they're getting out within a year, then SBA will allow you to purchase it under the same conditions. If it's got like a 5-year lease or 3-year lease, you're like, I'm going to move in 3 years, that's not going to work.
What about for land, if you're gonna do like a land lease to somebody? Would it work for that,
Will a
SBA?
when you say you're going to do a land lease, what do you mean?
Where someone is actually building on it and you're using part of the property still.
So are you the one that owns the land, or
Right. You buy the land and
you can't use SBA to buy the land? Because then you're just leasing it anyway.
Well, if you're still using part of the land itself. Like say you lease 50% of the land and someone builds on it and you're using that other 50% of the land, whether it's a detailing or a parking lot or picnic tables for a bar or something like that.
Yeah, I don't know. That's
Very specialized.
That's
type of
very
financing,
specific. If you have that type of scenario, we could look into it. But it's definitely complex.
Yeah.
It's definitely complex, and I don't know the answer to that. But essentially, you're saying you're just leasing half of the land, and you're using 51%.
Right.
There's potential that I would imagine there's potential. But it's figuring out what's actually 51% and how you're using 51%. Just owning 51%.
Right, just having the land.
Yeah, just having. Yeah, so if you have a building and you have all this land outside, but you're not using it for anything business, you're not going to get any kind of credit for that. But if you're, like you said, if you have a car dealership and you filled the whole land with cars, you probably have a better opportunity.
How soon do you as the broker have to be involved in the financing aspect of it? So is it while people are underwriting deals? Is it while after they have an executed LOI, letter of intent?
So I'm of the feeling that the sooner the better, because you can start to figure out, you may not be able to go to lenders yet, but get an idea of what to expect so that you're sizing it properly. Also, sometimes we can get a head start, right? Somebody's like, hey, I got an LOI, but we don't have a contract yet. Hey, let's start getting the thing together, because a lot of times one of the biggest challenges run into is people negotiate the closing date, right? Hey, we're going to close in 45 days, but hey, all lenders are running 60. So we're going to run into a challenge here. And most of the time, the truth is you get extensions, but it creates stress. And I'm not a huge fan of knowing we're going into something that's not going to work. And we still run into the problem now, but it's more because lenders are taking longer. Lenders aren't operating on speed anymore. Previously, a couple of years ago, people were winning, contracts based on speed, just like they do with a house or whatever. It's like, oh, I'll close in 45 days. I'll close in 30 days. okay, or I'm closing in cash, but they really weren't, and then they're trying to get a loan, and now you got to hurry up and squeeze it in. But when I would know something was coming short, or even didn't, if we wasn't that short, I'm always like, let's get a head start. If we know you're going to get the deal, a pretty good idea you could get the deal, let's get everything together. Let's start putting the package together. I mean, I spend a lot of time putting together my underwriting package, so that I go with the philosophy that's you lead a horse to water, and hopefully they'll drink. It's I don't like them to connect the dots. I like to connect it for them. So if we can get a head start on that, I'm all for it. And I never think it's too soon. It's like some people will call me and say, oh, I don't want to call you because I didn't have a deal yet. But I talk to people all day long that don't have deals, and kicking tires and things like that. So I prefer to come sooner because we can get ahead of things and we can prevent problems. Versus once it's under contract, now you're under the gun. And a lot of times you'll get a period of time where you can get out of a contract, like a study period in a commercial transaction. You don't want to use that whole study period gathering documentation. You want to use that really trying to figure out, like, hey, is the lender going to like this? We sometimes get the appraisal done in that time frame and see what the value. So where we are, all of a sudden, hey, I'm buying this thing for $2 million, and I think it's going to be worth $3 million when I'm done, but the appraiser is just going to be worth $2.5 million. Well, now I'm getting less money. Hey, you know what? I'd spend $5,000 on an appraisal, but I want to get it out because I don't want to put throw good money over bad. So I'm a big proponent of getting in early.
Last question I'll ask: what are the 3 most important documents that a borrower should have prepared when they're going into a commercial purchase?
From a
what are the
Personal
3 things that you're going to immediately need outside of the contract, the PSA?
Yeah. So I would say from a personal standpoint, we need a personal financial statement. And so
you should create one of those and have it ongoing and updated.
Just update it. Yeah.
I update mine monthly. Every month I have a PFS that I update every single month based on what the markets are.
It's important because sometimes it asks for people like, I don't have one. It takes all this time to get it together. And we spend time on data collection, document collection. So I would say personal financial statement, a pro forma operating statement. So pro forma projected profit and loss, so income and expenses, and projected rent roll. I think that's the most, in order to size a loan, those 3 documents. If I have those 3 documents, I can get a pretty good idea. Are you going to be a suitable sponsor for the deal? And then what does that, what can we size this deal? What will it look like? And those are really I would say those are the 3 most important.
Cool. All right, everybody give Adam a round of applause.
I appreciate the time. Thank you, guys.
Thank you. Use them as a resource, whether you're trying to get into your first deal or you're doing deals. Adam and I are working on, I've been one of the tire kickers with him for quite a while now because I haven't been able to make anything pencil, right? We're always talking, and when we do find a deal, he's gonna go looking for debt, right?
A lot more tire kicking is necessary these days, unfortunately, because it's harder to get deals that pencil.
Correct. So use him as a resource. Reach out to him, get his card before we'll be hanging around answering any questions that may come to mind. Thank you for coming, and hopefully we'll see you next month. So thank you.
Thank you.
Cool. Good stuff.